Let us start. Okay, so today we are going to start bonds and loans. So we will first understand a few things about bonds, what bonds are and how do they work. So normally when we talk about a bond, it is basically a fixed income instrument that represents a loan made by an investor to a borrower. So then a bond is such an instrument which guarantees. Just a second, guys. So which guarantees a fixed income along with the rate of interest as well as return also. Okay, so this is what is bond. So what are the types of bonds? So when we talk about bonds, there are multiple types of bonds, which includes treasury bonds, government bonds, corporate bonds, junk bonds, foreign bonds, mortgage-backed bonds, municipal bonds. So we will discuss each type of bonds. And also in this session, we are going to do a bit of brainstorming about different calculations. So we'll do that. Now, when we talk about treasury bond, treasuries are issued by federal government to finance its budget deficit. Now, what happens? Why do I issue a bond? Why do I take a debt? Sorry, because I have some shortage in fund when I want to do certain activities and I need fund for that. Either I use my own money or I raise a debt from market. Now, there are two ways to raise debt. One is I raise debt from the financial institutions. The second is I raise debt from public by issuing a certificate. Now, as we all know, there are two things. One is equity, another is debt. Okay. So when I raise debt, I have to guarantee them return with a certain, one is the entire money will be refunded to them along with a certain rate of interest of the uh, pricing. Okay. So what for treasury bond is, treasuries are issued by federal government to finance its budget deficits because they are backed by Uncle Sam's awesome taxing authority. They are considered risk-free, credit risk-free. But the main downside of these bonds are their yields are going to be the very lowest. So as you know, like we keep on investing in government securities where the yields are low, but those are secure. So the concept is that. So for which once we go for a higher yield giving bond, then probably we have to have a higher risk appetite. This is a government bond is again a debt security issued by government to support government spending and obligations. So we know there are a lot of government bonds. Next, we are going to discuss a bit about corporate bond. So what is a corporate bond? A corporate bond is a security issued by a corporation. So suppose L&T is issuing a security. Tata Power is issuing a security. It represents a promise to pay bondholders a fixed sum of money called the bond's principal or par at face value at a fixed maturity date along with a periodic payment of interest. So what happens? So I am purchasing a bond, say a 1 lakh rupees face value bond at 5% coupon rate. That means what? That every year I am going to get 5% return on that bond, and at the terminal value I am going to get that interest plus I am going to get that principal back. The concept is like that. So if I show it in the Excel, it will be something like this. So say 10,000 at par value, coupon rate is 5%. Now year one, and the tenor is 5 years. Year one, year two, year three, year four, year five. So we are going to get 5% of 10,000, which is 500 for these 5 years. But what happens at terminal value? It's not only 5,500, but we are going to get that 10,000, the principal. This is what we get. This is the cash flow. Now, as a principal, what we do, we discount it. So that is a secondary concept, right? So it represents a promise to pay bondholders a fixed sum of money. Yeah, Chandrasekhar, tell me. You can't see the Excel? But yeah, Praveen can see it. Praveen is mentioning he can see it. Wait. Now can you see? Okay. No issues. No issues. Okay. So what happens? I have purchased a 10,000 rupees par value bond at a coupon rate of 5%, and the tenor is 5 years. So what happens? Every year I am going to get 5% of 10,000. That is 500, 500, 500, 500. In the last year, what happens? I get 500 plus the principal amount. So this is going to be my cash flow for next 5 years from this instrument. Now, do we actually get this amount? No, we do discounting, but that is a secondary concept. So I'm going to discuss that part, right? Okay. Now we talk about junk bonds. So there are certain bonds which we see which are offering you very high rate of interest, very high return. So they could be offering very lucrative rate of interest that people gets attracted to them, but those are junk bonds. So what is the risk of junk bonds? One is higher risk of default. So they might not return your money. This has happened in multiple cases in scams and all this. Like for an example, I don't know whether you have heard about Sharda scam or not. There was another scam which cropped up a few years back. That is a company who is into plantation, and they had raised fund from market, and they were luring investors like anything, any rate of return, that in 1 year your money will be doubled. Rose Valley. Yes, Rose Valley. I remember Rose Valley. So those are chunk bonds. So they can offer you 25%, 30% return in a year. They can offer you even 50% return. Now, why do they need to offer you such a high rate of return? Is they are struggling to get fund in the market. So if I am a company, I have a very poor rating and I'm not credible in the market, investors are not ready to put money in my company. So what do? I offer excessive high rate of interest, lucrative rate of interest to investors, and then I come up with a bond that is named as junk bonds. It is issued by companies that are new to the market. Either I am new to the market, or I'm struggling financially, or have a poor credit rating. Okay. foreign bonds and euro bonds. So a foreign bond is a corporate bond issued by a foreign entity in the domestic currency of the country of issue. So if you are in India and you are purchasing a foreign bond from US, so you will get the bond in US dollar. So British company that issues a dollar bond in the US market. Uh, German MNC issuing dollar denominated bond to the US investors. Foreign bonds have names symbolizing the country whose currency is being borrowed. So Yankee for dollar, Bulldogs for sterling bonds, Samurais for yen, and Matadors for Spanish euro denominated bonds. So these are called foreign bonds. So when we will touch sovereign bonds in next week, so we will touch a bit of foreign bonds. Now, how does Eurobond works? This is a flow which shows this is the way Eurobond works. One is it issues a bond of fixed income. A corporation issues a fixed income debt or a bond. Denominations it in a non-native currency. So if I am in India and I want to issue a bond in say Singapore, so the currency will have to be a Singapore dollar. Introduces in Japan, becomes a euro bond dollar, euro dollar. This is a mortgage bond or mortgage backed security, refers to bond backed by pool of mortgages. So what happens? I have a pool of security. So what I can do, they are my debtors. So debtors means my assets. So if you look at the balance sheet of a bank, what are the assets of a bank? Then write in the chat box. Please write in the chat box. What are the assets of a bank? The major assets of a bank. Loans means debtors. It is debtors. Right? Cash bank is okay, but the major asset, when we talk about portfolio, it is the debtors who are the major assets of a company. Now, when I am issuing a bond for my home loans portfolio, what happens? I have a collateral of properties. I have a collateral of properties, right? So I am offering that, fair enough, you give me this much amount of money. I am issuing a security certificate to all of you. And your money is secured because I have property as a collateral. I have property as a collateral. Now think of a scenario. I have 100 crores of rupees. I have started a lending business where I have invested 100 crores. Currently, so I started recovering money in the form of installment. I started recovering money. And say currently I have a pool of around 80 CR. That is my portfolio size or my debtor size. Against which, you know that 100% of the properties are not funded, right? Do we fund 100% of the properties? So normally 70%, 80%, 90%, we go up to 90% also. So what happens? Say if my portfolio size is, you can see my Excel, right? If my portfolio size is 80 CR, ideally the asset backed securities should be 100 CR normally. So what happens? In some cases, I have funded 90%. In some cases, I have funded 60%. So with an weighted average, probably it comes to 80%. So 80% is the pool value. So 80% is the pool amount compared to the asset-backed securities. Right. So the debtors, So the creditors to whom I am going to raise money, they think that fair enough. They are giving me a collateral of 800 CR and I am putting a money of say around 70-80 CR, which is good enough. So I can easily, fund money, or we can, as a consortium, we can fund money to them and they issue a certificate. Now tell me, in this case, what is the risk? What is the risk in this case for the investors? Please write in the chat box. What is the risk for the investors? Some loans going bad, but in that case, they can recover by selling the property. Agreed. Home loan default, agreed, fair enough. But they can recover by selling the property. So where the risk is? Yeah, that is one process, that lengthy process of recovery, especially in case of property loans, and you have to, yeah, time value of money. So what I am supposed to recover today, I recover it 5 years down the line with lots of legal cases, and those are also expenses. And by that time, probably, like my time value of money shows that it's nothing. This is one risk. Second risk is, or which is the primary risk? This is a secondary one you are talking about. So what is the primary risk? Yeah, Abhijit, that is true. Credit request risk if the money is not received, but then the mitigate is you have a property collateral. Right. Asset liability mismatch. Can you slightly elaborate this point, Chandrasekhar, when we talk about asset liability mismatch? So Praveen, your point also comes in asset liability mismatch. So what happens is my property value goes down, can be one risk. The other most important risk what comes into the picture is I have overfunded. So when I talk about overfunded means a property is ideally, as per market, is valued at 80, right? I had considered, or I had done some kind of goofing, and I have considered a value of 120, and against which I have given a loan of 100, right? This happens. So Chandrasekhar, that is something is important. When I talk about asset liability mismatch, is basically in lending your value of asset, right, and the amount you need to pay back. My value of asset actual value is this. What I have considered is this, and I have given a loan of this. Now what has happened with non-repayment, with the accrued interest, with the different check bouncing charge, if I have initiated legal, then what happens, this 100 rupees, suppose I am assuming that the client has not paid a single paisa. The client has not returned a single paisa. I assume that. In that case, what happens? This 100 becomes 110 with the accrued, ODC, check bouncing charge, legal charge, this charge, that charge, it goes up to 110. And your property value is 80. Now, what is the collateral gap? The collateral gap is actually negative. You are at a loss of 30. You are at a loss of 30. Right? This is a major risk for the investors. So you actually don't know whether the collateral is proper or not. Now tell me one scenario. Something can come in your mind that why don't the investors they get the valuation done. Fair enough. They can do it. They can do it or not. Can they get a valuation of the collaterals? Correct. They can do it. But when it becomes possible, when the number of loans or number of debtors are small, say there are around 10, 15 debtors, so you initiate valuation of the property for 10, 15 properties. Now say in my portfolio, there are 500 customers spread across India. I have to initiate valuation for 500 properties, one approach, or else I pick up a sample of say around 10% from different locations. Now this 500 is spread across all the region, east, west, north, south. Numbers vary region to region, right? So what I have to do, I have to initiate 500 valuation. Now, how long it will take to get 500 valuation report? How long it will take to get 500 valuation reports? This is approach one. You have limited number of vendors. Now it is not only valuation. When we talk about property, there are two things which comes into the picture. One is technical value, another is legal. Anybody from home loan here? Anybody who is an underwriter of home loans? Sales of HL. Very good, Yashwan. So you know, right, that both legal and title, everything needs to be taken out. Now, why do we extract title, legal? Why do we go for a title search of a property? The ownership of the property, number one. Second is to check encumbrance. Encumbrance means whether the property is already financed to some lender or not. Whether the property is already under financed. Now there are cases happened in ICICI also. This case happened where even the relationship manager and the broker were sent to jail overfunding, dual funding on the same property. It was caught and they were punished by jail of say around 6 months or 1 year. It is a fraud, pure fraud. So the same property which got financed by two different financiers. So it was very common in earlier days, say when we didn't have so much of monitoring, you could have seen a go down where in one gate was maintained for SBI, where it is written that hypothecated to SBI. On the back side, there is another gate where it is written as hypothecated to Punjab National Bank. So both the banks are funded on the same property without knowing that other bank has also funded. So this used to happen. So to avoid this kind of situation, we take out encumbrance, non-encumbrance certificate that no, the property is free from any kind of encumbrance. That is a basic requirement. So this norm has come because of this. Okay, now coming to the point is, how long it will take to take out 500 valuations? You have limited number of vendors. So in east, west, north, south, probably around 200, 300 properties are there. So how long it will take? It might take 6 months. It might take 1 year. Correct or not? Right? Then what is the next option? What could be the approach to? Approach 2 is sampling. We pick sample, few cases from east, few cases from west, north and south, like that, and say make a sample size of 50, and then we go for valuation of those properties. That is second approach. Now, what is the disadvantage of second approach? You can write in the chat box, what is the disadvantage in the second approach? My life becomes easy. I have only 50 properties to value from different regions. But what is the disadvantage? Correct. So it's a small set of sample. We don't know whether something wrongdoings has happened anywhere, which is not coming in the sample, right? So this is a major problem. And if you look at the portfolio of PSU banks, I have seen in multiple cases there are overvaluation and overfunding. And actually when it comes out is when the customer doesn't pay money, with legal steps you repossess the property and you put a notice in a newspaper that we want to sell this property, which is repossessed, or what do you say, that distressed sell and all these things. You put it in a newspaper. Then the customers who are willing to purchase, they have to bid for it. And when they visit and look at the property, the valuation could be say around 70-80 lakh, but the bank is asking 1.5 CR. Now, why the bank is asking 1.5 CR? Because they have already funded 1.4 CR on that. And clubbing together all these charges, accrued charges, they have to recover from the next person who is coming to purchase that property. And this is a real life scenario. I have seen in the case of SBI. When SBI was funding assets, so one case in SBI, one case in PNB, I have seen myself. So this is the major risk in mortgaged bond, right? Now, how to counter that risk? So when we talk about countering that risk is something which is obviously a trend analysis. So you see in the past how this company has issued bonds and how they have paid money to the bondholders, to the investors. This is one approach. Second thing is that all these bonds gets rated by reputed rating companies. So you can at least believe them that when they are giving a rating for this rating, AAA rating for this bond, then this is a safer bid to invest. So again, we will cover credit rating in tomorrow's session. We'll start credit rating in tomorrow's session. Okay, somebody is written in IB. We have sent that due to illiquidity market. Correct, you are right. You are right, Praveen. Praveen, you are with which company? Okay, Credit Suisse. Understood. Okay, let's come back to the PPT. There are other type of bonds which are known as municipal bonds, which allow investors to lend money to the local government so that they can fund daily operations such as public work projects, such as road construction, improvement to schools, hospitals, and more. Now, the question is where from the municipality will get money when we complain that the roads are so bad in our city, or the water system is not there properly, the sanitation is not proper. So they need fund. So one is either they get the fund from the government. When that is not proper, then they raise bonds. They go to public to raise money in the form of munis or municipal bonds. and that money is used for doing all these social activities, right? Now, this is a typical formula for bond price. One is coupon, 1 plus YTM. YTM is yield to money. We will come to that concept. What is yield to money, yield to call, yield to worst? We will talk about it. And this is very much similar to the discounting. The only thing is that in discounting, you discount an uniform cash flow. Here you will get the face value of the investment also at the terminal, right? This is a typical formula. So there is a quick brainstorming we will do here. So 5 years, 1000 par value bond bearing a nominal rate of interest of 7% per annum. The investors required rate of return is 8%, and we are to find out the purchase price of the investors willing to pay for the bond now. The okay. So when we talk about, so I have actually given clue here. So when we talk about a 7% coupon rate and the YTM of 8%, 5 years bond, so we have to find out the purchase price of the investor, the price that investors is willing to pay for the bond. Calculate the present value of the bond quickly. Max 10 minutes given. Please find it out. 10 minutes is okay? 10 minutes okay? Can you guys write? Okay. Please find out the present value of the bond. Just a quick question I asked in starting also, since this is a short course session for CCRA, going through these sessions and books would be sufficient to clear the books. Questions are enough to practice. Yeah, so books questions are enough to practice. Plus you follow these webinars, and in the webinars I try to put something in practical. Might be you will not get every topics in the exam, but obviously this practical approach will help you to crack interview in case you are looking for a job. And also in case you are a professional, then obviously these things will help you in your professional activity. Does this answer your question? So see, the question is, I understand your question, but thing is that all these case studies, these are small case study kind of thing where we are practicing, and this can be there in your exam. So these are the assignments basically. So one assignment I gave in the first day. On the second day, I did not get a single response on that assignment. Nobody has given me the figures. Nobody has done the calculation. So what I can do? Assignments are given to you. Okay, Amit. What about others? Correct. Praveen, you have rounded off, right? Yeah. So you have rounded off. Okay. What about others? No, Kulal. 95 is not the correct one. So if you directly calculate the NPV, then how do you consider the terminal value? You can directly put a formula. Yeah, 960 is the correct answer. You can directly put the formula. But again, I told you there is a difference because there is a terminal value. You have to consider that also. What about others? Okay, Ashwan. Yeah. Credit Suisse is a big name. Okay. Guys, I didn't get an answer from the others also. Like, we have to go to the next topic. Should we proceed? See, these are small exercise. You have to do it actually. If you don't practice, then you talk about assignment. It doesn't make any sense actually. So if you start learning coding, you have to do small exercise. Then only you will be able to write a big code, right? This is the concept of yield to maturity. It is the rate of return that an investor is expected to earn on an annualized basis expressed in percentage in terms of bond purchased at the current price at the market. So what happens is, look at the formula. I is the annual interest. So if I am saying a coupon rate of 5%, so that is my annual interest, right? Plus RV is the redemption value. MP is the market price. N is the number of years remaining to maturity. So this is the entire formula, right? I just quickly go through it. It is the internal rate of return earned on a bond if held till maturity. YTM is the rate of discount which makes the present value of cash inflow from the bond in the form of interest and redemption value equal to the cash outflow on purchase of the bond. Yeah, you can, but the concept needs to be very clear. So I have given you a problem. You can take a snip of this and calculate and solve this problem, the next problem. Please take a snip of this and solve the next problem. So Kunal, in that case, you can send it to me by mail through Equalify. So 1000 doesn't needs to be discounted. Yeah, 1000 needs to be discounted. Correct. No, it's not because of the 1000. He has not considered 1000 actually. That is the major problem. He has considered only the returns. He has not considered. Yeah, he has not considered 1000. Correct. Yeah. He has missed 1000. That is the reason. So that is why I told him initially that there is a terminal value. When you put a formula of NPV equals to NPV, we all know that you will get the NPV, but here it will not work. Here it will only work if you add 1000 to the terminal value, and then only you can consider the entire series of cash flow. Okay, let us have a quick check in the Excel. Not to worry. Let's go to the problem. The bond value was 1000, right? Coupon rate was 5%, right? And YTM was 8%. YTM was 8%. So when you draw the cash flow, CF1, so for 5 years, 1, 2, 3, 4, 5, what do I get? 50. It's 1000 or 10,000? 1000, right? No, coupon rate is 7%. Sorry. 7%. So it is 70. But the terminal value is plus 1000 rupees. right? Now, who was doing it? Now you do the discounting. So either you discount for the cash flow for every year, or now you can put the NPV formula, right? Now, when we put the NPV formula equals to, let us see whether can do it or not. What is the rate? Rate is 8%. So it's 960.07. Even if you put it a formula, it's 960.07 because you know the cash flows. No, coupon rate was 7% and YTM was 8%. This is the problem. This is the problem. Coupon rate is 7% and YTM is 8%. When we talk about see, the sentence comes like this. Remember, in bond, a 5-year rupees 1,000 par value bond bearing a nominal rate of interest of 7%. That means, or you can see a sentence like that, a 5% 1,000 rupees bond or a 7% 1,000 rupees bond. That means that percent is the coupon rate. Is it okay? So it is coming as 960. It's coming as 960. Right? Okay. The next problem. This is the problem. 10 minutes given. Could you guys take a snip of this? Yeah. Next problem. So we have given yield to maturity formula. You guys can take a snip of this problem also. Then we can refer to the formula. Let us make our life bit easy. Okay. Is it 4.72 for everyone? Everyone got it? Yeah, sure. 10 years. N is 10 years. So the values are close. Somebody got it 4.725 and 4.76. Someone said 4.72. 1.4. 4.72 should be the correct answer. So 4.7182 is equivalent to 4.72. That's okay. Fair enough. Kunal, this is also okay. So 4.7183 we can write as 4.72. Others? So only 4 or 5 people have replied out of 31 participants. Yashwant, why it is going above the head? It is a simple formula which is given and a problem is given. You have to put the figures in the formula and find the result. That's it. Amit, just quickly recheck. It has to be 4.70. Just put the figures in this formula. See what is the MP market price? It is 1100, right? What is the par value? It is 1000 rupees. Okay, let us go next. 4.76 and 4.72 are quite close. It's quite close. So what I can do, I'll show you, I'll send this entire calculation properly to Equalify and they will share it with you. So somebody who has already done a correct calculation, it should ideally match, right? Let us not do right now. We'll show you the entire calculation and send it to Equalify. You will get it. No problem, you will get it. No, not 6%. One sec. Let me see what you have done. I plus. So when I talk about I, the annual interest. Now, the coupon rate you have considered as 6%. Okay. N you have considered as 10 years. Okay. Since the coupon is 600, so it is 60. Time is 10 years. Par value is 1000. Current price is 1100. So YTM is 6%. No, it will not 60. I'll share the entire calculation. Don't worry. Let's have a look of yield to call. Some bonds may be redeemable before their full maturity at the option of the issuer or the investor. In such case, two yields are calculated. One is yield to maturity, another is yield to call. Yield to call is computed on the assumption that the bond's cash inflows are terminated at a call date with redemption of the bond at a specific call price. Thus, yield to call is that rate of discount which makes the present value of cash inflows till call equal to the current market price of the bond. Same method as YTM would be used except for N now being the years remaining to call. So YTC greater than WYTM, it would be advantageous for the investors to exercise the redemption option. So what happens when your yield to call, like if I call the bond and it is giving me financially a better amount compared to the option if I wait till maturity, then obviously it makes sense to exercise the redemption option. Whereas if my YTM, so if I wait till the time of maturity and whatever value I get is more than my yield to call, then it would be better for me to hold the bond till maturity, right? This is a typical formula of yield to call approximate, where C is the coupon payment or annual fixed interest. Yield to call, FP is the face value of bond, CP is the call price of the bond, and N is the number of years to call. Quickly take a snip of this. We'll have another problem to solve. Please take a snip of this. We have another problem to solve. Could you take a snip of this? Okay. And this is yield to worst, that is minimum of yield to maturity and yield to call. Now, this is a problem where we have to find out two things. One is yield to call and yield to maturity. So yield to call formula is this. Yield to maturity, we have seen the formula how to calculate. And then I am going to calculate yield to worst. Right. So given these figures, first you find out what is the yield to maturity, then you find out what is the yield to call, then you will be able to find out what is the yield to vest, yield to worst. What is that? The minimum of YTM and YTC is YTW, right? You can start. You can find out yield to call first, then you can find out yield to maturity, and then you can see which is the lowest among that. The lowest one will be yield to worst. See, when I talk about callable after 5 years, remember, then the remaining value is 5 years. So if you execute your yield call after 5 years, the remaining one is 5 years. So Yashwant, you got the answer? Second. Mm, so do not write that YTM equals to YTW, but write YTW equals to 4.99. So Praveen has got 3.9%. How? YTC is 3.9. Let me check. So coupon payment is the fixed annual interest. So when I talk about coupon payment, that is here in this case, it is 5%. That is 5% on 1000 is 50 rupees. So C is 50, right? C is 50. अरे यार. right? Face value is 1000. So when I say face value is 1000, that is FP is 1000. FP is 1000. Now CP is call price of the bond. Call price is 1050. One sec, guys. CP is 1050, right? Maturity 10 years. There's so many messages which is coming. Let me check. So maturity is 10 years. So when I talk about N is the number of years to call. Number of years to call is 5. Number of years to call is 5. Right? Callable years 5. Right? Not the maturity one. Right? So what I have C, I have FP, I have CP, I have N. Now the formula is FP minus CP. What is my FP minus CP? FP minus CP in this case is negative. It's negative, minus 50. What is my C? My C is 50. So the numerator, FP by CP by N is 5. N is 5, right? So FP minus CP by 5. This is basically nothing but minus 50 by 5. So it comes to minus 10. Now I have to get the numerator. Numerator is C plus FP minus CP by N. So C is 50. So 50 plus this comes 40. So my numerator is 40. Numerator is 40 means C plus FP minus CP by N, that comes to 40. Right? This is my numerator. Now I'll calculate the denominator, that is FP plus CP divided by 2. Right? So I have FP, I have CP. Divided by 2 means average. Average of this two number, 1025. Right? 1025. Now I have to find out the YTC. YTC. Right? So if I find out YTC, that comes to FP plus CP divided by 2. Right? That comes to 5. Now, if I convert it to percentage, my YTC is around 4%. It is 3.9%. It is 3.9%. Did anyone consider this, N as 10? Has anybody considered N as 10? So if you consider n as 10, then you will get a wrong result because it is callable. N is callable. So you can call it after 5 years. Correct. So it will give you YTM. So that's why you got 4.39, right? So it is actually 3.9, which is the YTC. And which is a lower one. Yeah, it is trading at a premium. That's true. Rule 2M. If a bond is trading above the face value, that means it will be lower. No, it is not mentioned, but the market value is 1050. See, understand one thing. The par value, see, when a stock or a bond or any instrument trades at a premium, so one is, there is simple concept. One is my market value, one is my face value, right? If my face value is greater than my market value, then it is trading at a discount. If my face value equals to my market value, then it is at par. If my market value is greater than my face value, then it is trading at a premium. See, understand, when I floated the bond, it was the par value was what? The par value was 1000 rupees. Now the market has seen, because of market sentiments or the company's performance, people are ready to pay 50 rupees extra for that, which means it is getting traded at a premium. Understood? Or any doubt here? Any doubt here? Yeah, sure, Chris. Sure, Kunal. I'll show the question. This is the question. So what I was saying, that call happens after 5 years, but what is the actual yield to call, right? Any doubt here? So significance is basically you do a comparative analysis whether it is better to hold an investment or you can call the investment. So you do a comparative analysis. Anybody else who has got yield to worst? So I got only response from 4-5 people. Yeah, so because why yield to call is lesser, it is better to hold till maturity. Absolutely. Only 5-6 people are responding out of 31 participants. And trust me, in your exam, you are going to get all these things. Yeah, so the problem is like that, Kunal. You can consider it at a discount and then see the calculation, what it comes. Again, you can make a presumption that it is getting traded at 950 rupees, not 1000 rupees, 1050 rupees. And then you see the calculation. Now, what I have considered here as 1050, if I consider as 950, what happens? Then YTC is 6%. It is better to call it right now rather than hold it till maturity. Now, that is what Praveen has said, but because it is getting traded at a premium. No, it's okay. It's okay. Fair enough. Okay, let's go ahead. Now there is a concept of pure discount bond. So what is a pure discount bond? It provides for the payment of a lump sum amount at a future date in exchange for a current price of a bond. So you currently pay something for the bond, and then after a lump sum period of time, you get a return. The difference between the face value and its purchase value, purchase price, gives the return or YTM of a bond. This is also called deep discount bond or a zero interest bond. Yeah, you can call it as a zero coupon bond as well. This is the formula of a zero coupon bond, where the face value of bond is discounted by the rate or yield and time to maturity. This gives you zero coupon bond value. So as on standing on today, you discount what would be the face value. So what happens today? I sell a bond at a discount, right? Say I discount by say around 20%. So 1,000 rupees bond is being sold to you at 800 rupees. And at the time of maturity, you will get 1,000 rupees. Now you see actually whether you are gaining or you are losing. How do I do that? Zero coupon bond value should be less than, sorry, more than the price I am paying for that. So when I talk about face value and rate or yield and time to maturity, I get the zero coupon bond value. We might have a problem after this. Yeah. So this is a small problem again, which you are supposed to solve it. A face value of 10,000, R is 8%, time to maturity is 25 years, right? You find out the value of zero coupon bond. Please do it quickly. You want to take a snip of the formula? Please do take a snip of the formula and find out the. So everyone has got 14.60, which is the correct answer. Yeah. This is a simple problem. Okay. Can we go ahead? Can we go ahead, guys? This is a relationship between the bond value and the interest rate. So there is an inverse relationship. Now, can somebody tell me why there is an inverse relationship between the interest rate and bond value? So when I talk about interest rate, which interest rate we talk about? Just write in your chat box. No, not the coupon rate. Market interest rate. Okay. Bank ROI. Okay. What else? So the overall interest rate in the market, when it is increased, right, automatically the bond value decreases. And when the interest is decreased, the bond value decreases. So what is the bond value? When the interest decreases, the bond value increases. Now, what could be the possible reason? Just do a bit of brainstorming. What could be the possible reason for this inverse relationship? Yes, correct. So if I get a better interest rate in the market, then obviously I will not get inclined towards the bond which is offering me a lower interest rate. Correct. Absolutely. I'll go for the interest rate that banks offer. Right. Similar to situation from last 1 year, repo rate is being increased. So have you noted actually the bond prices coming down, Yashwan? Okay. Any example of any particular bond which you have observed or studied? Any particular bond you have studied? So what is the relationship between the equity market and bond? Okay. Yeah, you are right. People tend to invest in bonds when the equity market falls. You are right. But then what happens to the bond market? So my question was, in case the equity market falls, someone has written that in case the equity market falls, then people invest in bond. So my next question was, what happens to the bond market? Okay. Yes, there are multiple factors which has to be considered. So there is a bond valuation itself is quite vast. Okay. Yeah. So inflation and currency movement, those are also a kind of intervening variable for a bond. No, but there is a relation. So there is a relation between two markets. My question was very simple. So what is the relation between the equity market and the bond market? So being an investor, I have invested in equity market and in bond market. Correct. So that is what my question was. If the market becomes too volatile and risky, probably I'll shift my money from equity to bond market. Correct, Abhijit. Okay. Now have a look at this chart. This is a 5 years, 10 years, and perpetual bond. And how the graph looks like. Yes, Wasim. How the graph looks like. Now, what is a perpetual bond? What is a perpetual bond? which has no maturity. Which has no maturity. Correct. Yeah, I can say 100-year. But what is the just a common question to this entire batch actually, one who is very much familiar with the bond market? What is the percentage coming in for perpetual bonds in investment terms? Like when I talk about investment, that have you observed that people are too much interested in going for a perpetual bond? What is the market trend? Yeah, because I also feel same that people might not be that much interested in a perpetual bond, almost negligible. Probably it used to happen earlier, but not now. Now comparing 5 years bond and 10 years bond, which is more attractive to the investors right now? What is the market trend? Longer is better now, I understand, but how much longer? 5 year is something which everyone goes for, like most of the people goes for. But don't you think that when you are investing in a bond, which kind of bond you are investing in, and when you are going for a 10 years bond, yeah, bond is definitely a bond. You will definitely go, you will get your money back. That's okay. But from the investment perspective, do you know there is a rapid changes in overall sectors, right? Across all the sectors which is coming. And especially when I talk about corporate bond. Yeah, I understand. Government security is okay. Yeah, corporate bonds are risky. And there is a, you can see a paradigm shift which is happening in the overall operations of the corporates. Now, when we talk about lower duration, lower means how much lower? 5 years is okay, I understand. But most of the people go for perpetual bond. I guess a very bare minimum people goes for nowadays. So currently the trend is more on the equity, what I have seen, rather than bond is kept as a tax saving instrument. And obviously, if you are into the treasury department, you have extra cash. Kunal, there are certain government bonds. As a modified duration. That's, yeah, so I was talking about that bond only. So Kunal said that tax free bond is not there, or you cannot save tax. So I am talking mainly about the government bond, infrastructure bond, which is issued by government. Obviously, those will come under 80C. You can save some amount of tax. Who said it, Kunal? Infra bonds are not available. It is very much available in secondary markets. New issues have not come recently, but that doesn't mean that it will not come. It's not that government has made certain rules and regulations that you cannot float infrastructure bond. It's not like that. If it comes out, it will definitely come up with a provision of ATC. Correct me if I'm wrong. There are people who are already working with bonds here. Seems like that. Okay, Kamlesh. Okay, the explanation of this chart is okay, fair enough. I understand. We are getting into a debate kind of thing, right? This is basically a chart which shows you a trend of 5 years, 10 years, and the perpetual bond, and how does the price changes with the increase or decrease of rate of interest, right? So this is just a observation or the trend from the past data. If it is a perpetual bond in the when there is a change of 5% rate of interest initially, there was sharp drop, almost 50% drop in the price. But at a later stage, the shock was minimized and the drop was not that significant. So it slightly started becoming flat. Okay. Next, coming to that is 10 years bond. And when we talk about a 5 years bond, it is slightly less, slightly more flat compared to a 10 years bond. So a 5 years bond will have a minimum impact on the price of the bond with change in rate of interest. That is what the picture tries to show. So longer the maturity, more the price falls, but initial shock was tremendous. That is what they are trying to, that is what has been proven. This is a chart which is available, and that has been observed from the past trend data. No, Amit, this is not a current interest rate chart. This is a trend which has been captured. It is available in the open source. So that's the last slide for this session. Guys, anything else? Anything you'd like to discuss? Then, yeah, absolutely, Kunal. Sensitivity for a longer maturity will definitely be more for a bond. So anything else you want to discuss, or otherwise we can wrap up and we'll reconnect at 10:30. Okay. Kunal, I have not got it, so I will ask Drishti to send it to me. They have not sent it to me. I will definitely ask Drishti. Okay. So people who are already into the bond market, probably they know much better than me. Yeah, sure, Arvind. Definitely. You can prepare in case you face any kind of issue. Please connect with me through Equalify. So you have a bond chapter in your syllabus also in the AI. Have you guys got your materials? Have you guys got the materials? Nobody has got the material. Okay. I see. So once you get the materials, even the soft copy, no recordings you will not be getting. The recordings will be uploaded in your portal. So for that, you just have to get in touch with Equalify. Okay, guys. Understood. So I'll also tell Drishti to look into this and check it with Equalify once. Okay. So once you get the materials, you will see there are chapters of bonds, credit rating, and different topics on rating, different topics on bond. So anybody who has done FRM here, then they have done an elaborate analysis on bonds. Somebody is FRM here, financial risk manager. Okay, Praveen. Then you must be very much familiar with the bonds in a much elaborate way. No worries, Abhijit. No worries. Okay, guys, let us quickly wrap up. Let's reconnect at 10:30. Thanks for attending the session. Thanks